company reported the following purchases and sales of its only product using the perpetual inventory system. In this example, I'm going to try to accomplish recording, if you will, using the perpetual method, the ending inventory and cost of goods sold, assuming LIFO, FIFO, and assuming LIFO and FIFO. So let's first do the easier one, which is FIFO. Given the data that you see on your screen, gives you dates, activities, costs of the units that were acquired or sold, and then the units that are sold. We're going to compute the transactions in such a way that we are going to automatically determine what our cost of goods sold per transaction, if necessary, and the changes it's making on our ending inventory. So when we have inventory and we need to show the flow of that inventory, not only coming in but going out, we can assume that the items that we purchase, or the inventory items we purchase, first will be the very first that we sell. That's the first in, first out. With that being in mind, perpetual system is telling us that every single time we have these transactions, purchases and sales, we are recomputing our ending inventory. So we're always getting a running total of what our ending inventory is. And we're getting a total of our cost of goods sold. So this demonstration is really just to show you the mechanics of how to calculate it. Now, if we're consuming FIFO, let's take the same data and say, okay, we purchased, or our beginning inventory, I'm going to put on here BB as our beginning inventory, well, I'll say BI, is going to be the 150 times the 10 units. Now, because we haven't sold anything, there's no cost of goods sold here. Now, our ending inventory, if you can think about it, is going to be this $1,500. Now, but on the 5th of May, 5/5, we made a purchase, and we purchased 220 units. So I'm going to use my calculation, 220 units, and we cost us $12 each. Again, we haven't sold anything, so cost of goods sold is not going to be relevant here. So what we have now is $26.40. Now, when you look at these two, our running total of ending inventory comprises of two layers. Layer 1, which is our beginning inventory, and layer 2, which is the purchase that we made in May on the 5th. Now, the next layer, it says on the 10th of May, we actually sold some of our units. If we sold some of our units, how many did we sell? 140. Well, the question is, where do we take the 140 units that we sold? From the top layer or from the second layer? Well, if we're using FIFO as our guide, we can honestly say that we're going to go right from the first layer, which is right here, which is the 150 units at $10 each. So if we have 150 units and we sell 140, we're going to take most, not all, of our first layer. So we're going to take 140 of layer 1, which is 150 units at $10 each. We're going to take 140 at $10 each. So right now, at the end of this sale, our cost of goods sold is $1,400. Now, let's compute our ending inventory. Because we have different layers, we're going to have to recompute. Now, a recompute of ending inventory. Well, our layer number 1, which is right here, if we had 150 units, we sold 140, we only have 10 units left. So about 10 units, we're going to multiply that by the cost, which is $10. That's inventory. That's the first layer that we have to deal with. This second layer has not gone away at all because we haven't had a chance to sell it. So then we're going to have to copy here and say, okay, our ending inventory is going to be the 220 units times the $12, which we have yet to sell yet. So at this point in time, if someone were to ask you, what's your cost of goods sold and what's your ending inventory, you can say right now, well, let me first make sure my calculation is right. 220 times 12. So if anyone asks you at the end of May 15th, what is the ending inventory and what is cost of goods sold? You can tell them ending inventory is $27.40 and cost of goods sold is $1,400. And I'm going to highlight this. But we're not done, because now we have one more transaction, which is, well, actually we have two more transactions. So at the end of all of this, from May 1st to May the 10th, we've got cost of goods sold at $1,400, and we have two layers of of our inventory. What was in our beginning inventory, what's left over, and our purchase on the 5th of May. Now we're going to May 15th, and we're going to add another layer to our inventory. Again, we're not selling anything. So we're going to say, oh, we're going to have inventory of 100 units multiplied times $13 each. That's our purchase. So now our ending inventory then becomes $1,300, $2,640, and $100. We have now 3 layers of inventory to consider. Why does it matter to us? Because when we have to use our perpetual inventory tracking system, we have to make certain that we have the layers sufficiently identified so that we know which section to take the inventory from when we have a sale. In which case, on the 24th of May, we have a sale. And that sale is 150 units at $21 each. Well, we don't concern ourselves with this example with the amount we sold it for, because we're not really trying to compute gross profit. But we do want to know how many units we sold. So of that 150 units we sold, we have 3 layers upon which we can draw these inventory items. First in, first out requires us to take 10 at $10. That's the first layer. Then, I don't know why it doesn't like to. There you go. Then of that 150, we took off 10, so now we have 140 left. The 140 is going to come directly from the 220 units that we had sold. So we're going to take the 140 multiplied times the $12. That gives us our 2. And remember, layer 1 is 10 at $10. Layer 2 is at 220 at $12 each. I hope that makes sense. Okay, it's not really liking what I did. So there we go. Makes sense so far? And then the third layer, which we have, is going to be the 100 units. 100 units at $13 each. Those are our 3 levels. Want to make sure those are clear. Our first level here. Now, when we have our sale on the 24th, we're going to take this layer, the 10 at 10. And then of that remaining 140, since we have 220 in the inventory to take from, we're going to take the entire 140 and multiply times the $12. Now we can compute our ending inventory. So our ending inventory is going to be layer number 2, 220 minus the 140. And I'm going to put that 220 minus the 140. And that's going to be the 80 times 12. Then our last layer is going to be the 150 units times 13. And we get 150 times 100 times 13 times 13. 100 units at $13 each. Very good. So at the end, we can say that our cost of goods sold is a combination of $1,760, which is the 2 sales here, the $1,760, and the $1,400. So our total cost of goods sold for this example that's our total cost of goods sold, and our ending inventory is going to be the combination here. So for FIFO, ending inventory is $2,260. Our cost of goods sold is $3,180. Gosh, there we go. Now let's leave this information the way it stands. I want to just copy And let's do a copy and paste function. I'm going to copy it right here. Let's do the same thing for the LIFO side. Using the same data, we're going to start off with our beginning inventory, BI, of $1,500, which is going to be the combination of 150 units multiplied times the $10 each. That's what we're going to start off with. Same thing. We have a purchase, again, same information. We're gonna have a cost of $26.40 because we're going to take the 220 and multiply by the 12 units. That gives us $26.40. So right now we have two layers, 1 and 2. Now on the May 10th we have a sale. The sale is 140 units. Well, if we can look at our numbers in terms of the number of units here, we can say here's 150 units because we've got it right here. We got 150 units here and we got 220 units. But LIFO says we're going to take the last purchased and then subtract. So from our sale perspective, we're going to take everything from out of this particular sale. So if we're going to say we sold 140 units, we're going to take that 140 units and multiply it times the $12. As you can see here, we're taking from this unit first, or this section first, or this layer first, and then we'll start to take from this layer. Remember, we're going from bottom to the top when we're talking about LIFO. It's a little bit different. I'm going to highlight it, and I want you to see how the changes in price affects the cost of goods sold and also affects the profitability, gross profit in particular. Now, with that in mind, let's calculate let's recompute our two layers. Our first layer is going to stay the same, which is going to be the $10 each times the 150 units, which is 150. So we got the $1,500 is our layer. We haven't touched it. However, with the 220 that we purchased, we sold 140 of them. So all we have now is 80 units. So the 80 units multiplied by the $12 gives us our second layer, 960. That's going to be our two layers, assuming the LIFO method. Now, the next step here is on the 15th where we have a purchase. So we've got now a new layer to add. And we got, 100 units at $13 each. So we're going to have 100 times the $13 each gives us $1,300. And as you can see here, we've got three layers. I'm going to change this color to make it a little bit different. Undo that. I'm going to change these colors here just so they can be different. So now we've got three layers of activity. Last in, first out. Now we've got on the 24th of May a sale. Where do we take the money? Where do we take the units? Well, we sold 150 units. If we look at our data, we have found that we've got 10 units we had $10 each for 150 units. That's the first layer. We've got 80 units at 12, right here. And then we have a final layer of 100 units at 13. Now, if we sold 150 units, what do we take from what? Well, in these three layers, 1, 2, 3, we're going to do the same thing again, go from bottom to top until all have been exhausted and are zeroed out. So in this case here, we're going to start right here at the 1,300. And we've got 100 units at $13, and we sold 150. So our first cost of goods sold is going to be 100 at 13, which will completely remove this layer. Then we've got another 40 to take. In this particular case, we got 80 left over. So I'm going to take 40 from that 80 at $12. Now we have our new cost of goods sold. And I'm going to do a sum total here. So now we know this is what our cost of goods sold is for LIFO. This sale and this total sale. Now, what do we have left? Let's look at our numbers again. What we have left is we have nothing left here because we've used it all. We used 100 units here, and we used 40 of the 80 that was left. So our ending inventory is going to be our 150 units at $10 each, which is going to give us $1,500. And then we're going to have our 40 units at $12 each. And I'm doing my calculation here. And then I'm going to run a total. So if I use my FIFO equation, I'm going to say my LIFO equation. My LIFO tells me LIFO ending inventory is $1,980. And it's different. Cost of goods sold, in this case, is going to be the addition of these two numbers, 1780 and 1680. So I'm going to add those two up, come up with my total cost of goods sold, and so forth. So I've got cost of goods sold is $3,460. Now let's take this a little bit further. What's the difference between FIFO cost of what's the difference between our FIFO gross profit and our LIFO gross profit? Well, let's do it. Here's gross profit, and I'm going to put on here F as in Frank for FIFO, and I'm going to put here gross profit, L for LIFO. Now here it is. So let's do sales. The sales basically are the same. We sold 140 units times $20. And then I'm going to put this in brackets just so I can have them both show at the same time. So 140 units at $20. Plus, we did a sale of 150 units at $21 each. That's our revenue. What becomes different, $59.50 for both FIFO and LIFO. What becomes different is our COGS. And then it comes with our gross profit. All right. So our COGS for FIFO, if we've calculated it, it is going to be $3,180. And our cost of goods sold for LIFO is going to be $34.60. So the difference between our sales and our cost of goods sold gives us our gross profit. We can now say then that our gross profit, LIFO and FIFO, are different, and this is an example of why. And we can look at it easily because we can say, oh, the biggest reason why they're different is because there's a difference in change in prices. So as you're going through looking at this particular transaction, you can say we have to create layers. We have to make certain that each one of our inventory layers are identified. And I use this as a spreadsheet because I didn't want to use it on a piece of paper, which would be harder for you to follow. But I can say that when we are trying to calculate ending inventory, if we assume FIFO and it's a perpetual inventory system, we are in a position to calculate ending inventory and our cost of goods sold after every transaction. First of all, in this case here, we were able to identify our ending inventory because here's our two layers. Then we recomputed our ending inventory because we in fact had a sale. That gave us our cost of goods sold, and it also gave us our new layers upon which we could move our inventory. Assuming top layer is going to be FIFO going straight down. In the case of LIFO, is going to be bottom layer going back up. And as you can see with the differences in prices got higher. And it reflected so in the cost of goods sold and the gross profit for both of these, for both methods. So you're talking in general, in the case of rising prices, FIFO is going to give you a higher gross profit. And then as far as LIFO is concerned, LIFO is going to give you a higher expense, in this case, cost of goods sold. Now let's take one more look at a problem and see if we can figure this one out. This is going to be assuming the lower cost of market. In front of you, you'll see some data. It says a company reported the following data related to its ending inventory, and it names the products, A49, A42, A47, and A60, and the number of units available and its cost. The question is asking you to calculate lower cost of market on the inventory individually and as a whole. This particular problem, I think, is best set up in a spreadsheet type of or column type of presentation, because it really does help you read it a little bit better. So what I'm going to do again is create a document that looks somewhat like what we have here. I'm going to copy my information, but I'm going to copy it as numbers. Here is just a picture. So what I'm doing here is I'm going to do a lower cost of market kind of thing. So I'm going to take and remove this, and you can see the data is the same. I'm just going to start calculating the total market cost. Now, we already know that these are the different products. We got 100 units, and this is what it costs, and this is the market value cost. Now, I'm going to add a column, if it's okay with you guys. Add a column here, and I'm going to do some calculations. So the first column is just taking and multiplying the two together, cost times the number of units. Does that make sense so far? And here's going to be total cost. Now I'm going to do the same thing here, but I'm going to remove this here and just do total market. And then I'll do another column. Okay. So first we want the total cost. So we took the cost and we multiplied the number of units available. And that's where we get the 1100. Now the next step is going to be the market cost by product. So I'm going to take, again, the market value in this case and multiply it times the unit available. 1100. Now, all you need to do really in this case, so I don't have to repeat anything, is just copy my formulas down. But let's talk about what I've done and what this information means. What we're trying to do really is compare what the market value is and what our cost is. And we're going to record the difference, or not say the difference, but we're going to be recording the lower of cost or market. So the cost is, again, what you actually pay for something. And we've calculated simply by multiplying the number of units times the cost value. And I'm going to put this in double brackets to make it a little easier for you to follow. This is our total for total cost. The market value we know because we can go to the store and we can say, oh, this is how much they're selling it for. What someone's selling it for is the market value. And again, taking that number and multiplying times the number of units give us out 1100. And again, I'm going to take the same thing and copy this over. That being said, this is what we have. We have all of the units, so we know our lower cost or market in each one of these. Now, the question then becomes, which one is lower cost or market? Well, we can do the LCM real quickly by product. How do we do that? We compare, and I'm going to put in some colors just so you can see it a little bit better. I'm going to put this color as a green. And here is the market. And then I'm going to take and put in yellow what is the cost. If we want the lower cost of market, which one we want? We clearly want the 1100. And I'm going to put this as yellow. And it's going to be a combination of, yellows and greens, but let's just go through it, the process. In this case, we got 1,050 is our market value. We got 1,200. Well, which one do we want? We clearly want this one. We want the lower of the two. And I'm going to color code this green to match the market. The same thing here. 780 is lower than the 840, so I'm going to use that. And the 800 is higher than the 600, so I'm going to use the 640. So the 640 is going to be the yellow. And the 780 is going to be the green. Let's make sure. I'm going to look at my numbers again. But again, we're doing the lower of the two. So by product, the lower of the cost or market for our product 849 is going to be the cost. The lower of cost of market for our 842 product is going to be the market. The lower cost of market for our product 847 is going to be the market again. And then the lower cost of market for our product 860 is going to be our cost. So by product, we know in total what is our LCM. Now, can we do it by product line, or can we do it in total? So let's do that. Let's do our totals here. Where's it? There we go. So the answer is applied separately. We've got our 3470 is our LCM. And that's the answer. What is going to be our LCM applied to inventory as a whole? And inventory as a whole is going to give us, I'm going to give you a different color here. I'll do blue. So for our LCM by product, it is going to be 3,470, and we've computed it this way. Our LCM, or our lower cost of market as a whole. And again, as a whole, we're comparing the 3,680 to the 3,730. Does that make sense? So as a whole, the LCM is the 3,680. And let me just hit my 3,680. But by product, the LCM is the 3,470. Now, my goal in this particular transactions, or these transactions, is to clarify when we're calculating in the inventory, the different methods by which we can do that. We can use a perpetual method by FIFO or LIFO. We can use our LCM, when we can use a weighted average. The end of the day is what is the measurement of the flow of inventory that best reflects what's really happening in your organization, and understanding the impact of either one of these methods on the cost or the inventory. So my advice would be to create an environment that you can follow each one of these transactions in a neat and organized way, whether you use an Excel spreadsheet or a sheet of paper. Organize it in categories so that you can clearly see each one of the layers that we're talking about when we're actually trying to compute what our cost of goods sold is and compute what our ending inventory is. So using a little bit more of a formalized, structured viewpoint when laying out the problem itself will make it much easier to understand exactly how to compute what our ending inventory is, assuming that we're using a perpetual inventory method. Again, perpetual inventory method is going to give you a running total of your ending inventory after transactions, particularly when we have a purchase and particularly when we have a sale. We'll constantly recompute on our ending inventory. And in each layer that we create, we have to know if we're using FIFO, we're going to go to the top layer until it's used up, and then we go to the next layer until that's used up, and then we go down, down, down. LIFO is the opposite. We go from the bottom layer and eliminate all of those inventory items, and then we go up and go up, go up. And as we saw in the previous example, rising prices do have an effect on gross profit. In this case, it created an environment where the gross profit was lower using the LIFO versus the FIFO, and you could tell because the prices were increasing each time a purchase was made. The sales were the same, but the cost of those products was going progressively up, and obviously affecting gross profit. I hope this video gives you some idea of how inventory is used in organizations, what it means, and why organizations are concerned about how inventory flows, and then ultimately how it looks on their financial statements. Most companies do use FIFO as their measuring stick, but not all use FIFO. Some use LIFO because LIFO is relevant. It's very relevant for perishable goods. You're going to make, you want to get the first in, first out, but reality is people go to the store, they're going to choose the most recent, they're going to choose the really the young stuff before going to the old. And consequently, organizations have to cut prices in order to get those items out. So an organization could use LIFO or use FIFO, or a combination of the two, or a weighted average. But again, I'm hopeful that this demonstration gives you some idea of how to organize your problems and how to present it in such a way where you can understand it and then ultimately able to respond and answer the questions.